Welcome to the podcast from Morningstar UK, the leading provider of independent investment research. This week, we discuss the autumn budget and what the announcements mean for investors. We'll also take a look at how the UK economy as a whole is faring as we come towards the end of 2017 and onto 2018. And finally, we'll have some stock picks for you specifically focused around income. Let's get straight into our main topic. Emma Wall, Senior Editor for Morningstar.co.uk and Morningstar Investment Management's Mark Preskett give their initial reaction to this year's autumn budget.
Hi, Mark.
Hi.
So I thought I'd kick us off with housing because that was arguably the sector that received the most attention in Philip Hammond's budget this afternoon. There was a very important pledge to help first-time buyers by abolishing stamp duty for any property worth less than £300,000, specifically for first-time buyers, and indeed said that Londoners don't get left out. Any property worth £500,000 or less will see the abolishment of stamp duty for the first £300,000. But that wasn't the only way that he helped people to get on the housing ladder, was it?
Yeah, absolutely. So previously it's all been about, last year was about Help to Buy and extending that programme and pledging, financing that programme. And he came under a little bit of criticism because it was people were looking at that stamp duty legislation and also house building properties out there. So that, you know, Philip Hammond sort of pointed out the Conservative track record is quite proud of building 1.1 million homes since 2010, but the latest pledge of a £44 million pound infrastructure fund and building 300,000 new homes every year from around the mid 2020s definitely stacks up in terms of the number of houses being built.
It's easy enough to make a pledge though, isn't it? But whether we see the reality of those 300,000 homes built per year over a certain 5-year period is another thing.
Absolutely. I mean, the problem has been local authorities and getting planning permission for these houses to be built. Big schemes, high density housings in urban areas. But so that the devil is in the detail there, how they're going to push through these quite aggressive targets on home building. Without,
of course, touching the greenbelt.
Absolutely, yeah.
And then looking at taxes, we saw taxes raised on tobacco and on cheap booze, but they have been frozen, he said, in support of the Great British Pub, but I think in the support of the Great British Drinker as well, on whiskey, wine, beer and cider. Where we have seen tax raises for the individual is for anybody that still drives a diesel car. The duty on those will go up, and also there are incentives for car manufacturers to get their plans in line to produce clean engines, those that do use diesel in a cleaner way. This was all part of an ongoing theme about clean air, and indeed there were measures to support electric vehicles, weren't there?
Yeah, absolutely. So you definitely feel there is a sort of a shift in sentiment around sort of clean energy, efficient driving, and getting our streets cleaner and pollution down. And so the electrical 40 million invested on electrical charging points, another 500 million in electrical car infrastructure. So it's definitely a step in the right direction in terms of that sort of moving to a more cleaner British road.
And this was quite a niche investment, electric vehicles. As you say, 40 million for charging points, around £500,000 into electric vehicle innovation. There was also a further £500 million into artificial intelligence, fibre broadband and tech startups. But all of this is only supporting a particular type of British business, a niche, small business. There wasn't much for the corporate sector as a whole, was there?
Absolutely. So the last 2 years, it's all been about these big corporation tax cuts. So we saw, corporation tax from in the budget in 2015 go from 20% down, and then last year they've ended up plumping on the 17% number that's coming in 2020. This year there wasn't really anything to do for big business, and I think maybe that was around that initial hit around Brexit sort of forced Philip Hammond to bring in another corporation tax cut. But here there was a few micro legislation, a little bit around taxation, but most of his points were around non-action, no change to the VAT threshold for small businesses, for example. He's not actually doing anything. He's just maintaining a relatively attractive level for small businesses.
Now, for most of our viewers, the thing that will impact the most and will be the best music to their ears are the change to the personal tax rates. And that's seen the personal allowance rise in line with the Conservatives' pledge at the beginning of the government to £11,850 from April. And the higher rate tax band will move to £46,350. There are also pledges to support the NHS and indeed education with £600 for every student studying a maths A-level for schools. But perhaps the thing we haven't talked about, which is the biggest takeaway from this, is the economic backdrop, because Brexit looms ever closer and it has actually impacted the forecasts for growth for the UK, hasn't it?
Yeah, absolutely. I thought it was quite interesting that Philip Hammond's very first statement was around Brexit, was around increasing the budget for the Brexit negotiations. And then he moved on to sort of the OBR forecast. This is the government's sort of independent body forecasting growth out, and they were very conservative numbers. The Bank of England has growth at forecast out to 1.7% out to 2020. These were materially lower, around 1.4 down to 1.3 in 2018-19. So pretty aggressive downgrades in our growth outlook. And against that, we've got this picture that the Conservative government has pledged to reduce debt levels. That's been at the heart of everything they're doing. We're bringing debt down, and so Philip Hammond was quite proud in talking about how debt to GDP levels will have peaked and will be falling over the coming years. But those falls are still pretty low compared to debt to GDP levels from the 80s and 90s, even up to the mid 2000s. We're around 50%. We're now up into the 90% level. We're pretty much there. He's forecasting it going to 86.1% in 2020. It's a tiny shift down, and compared to other European nations, we still have a problem with high debt and low growth.
Mark, thank you very much.
Cheers. Thank you.
Up next, Emma talks to Adrian Lowcock, Investment Director at Architas, to get more detail about what the latest budget means for savers and investors.
Hi, Adrian.
Hi.
So there were a few changes for investors in the budget. It was a budget of investing in innovation, in AI and in tech. And one of the ways you can access these sectors is through enterprise investment schemes. And Philip Hammond did announce some changes to EISs, didn't he? What did he say?
So the big announcement was changing how much you can invest into EISs, and this has gone up from £1 million to £2 million. So it's for those high net worth investors, really. But there was a sort of caveat to this. It was only in knowledge-intensive companies that this allowance would be increased for, so not for everything else. Also, he slightly tweaked the rules for EISs that for the companies that receive EIS funding. At the moment, they're capped at sort of £5 million, but that will go up to £10 million again for these knowledge-intensive companies, and that the total amount that a company can receive from EIS funding will be at £20 million.
What exactly is a knowledge-intensive company?
So basically, you need to use around 15% of your operating costs over a 3-year period, or 10% every year in 3 years, in research and development or innovation. You also need to have a certain amount of the right type of staff, so individuals with master's degrees, and they've got to take about 20% of your staffing requirements. So it's quite specific actually on that, and the whole point is, again, it's to sort of support this technological innovation and really get sort of entrepreneurial businesses off the ground. It's
a very clear theme in the budget of supporting that particular sector, and for those in the know, this may well be a great way to access that particular part of the economy. But for those who are unfamiliar with the EISs, what are these schemes?
So basically they are tax incentive schemes. They give you lots of tax reliefs, 30% tax relief, income tax relief, capital gains deferral, no capital gains on any gains made. So they're really targeting sort of people to invest in these smaller businesses. And you can put in currently £1 million. There's lots of rules about what types of businesses qualify, but they're usually smaller companies, very very small businesses, sort of startup companies. So effectively, they're wrappers that allow you to invest in very small UK businesses to generate sort of interest in UK smaller companies and those entrepreneurial startup businesses.
But not only because of the very high initial investment requirements, but because of the nature of the businesses that these schemes invest in and support. This is not a scheme that's suitable for everybody, is it?
No, absolutely. EISs, along with things like VCTs, which are very similar, they are really for higher net worth individuals. Those with sort of who have used their ISA allowances, who have used their SIP allowances, have a very diversified portfolio and are happy to take on a much higher level of risk. So this isn't really for everyone, and that's probably one of the criticisms of EISs and the announcement yesterday, is it's going to be very much for the higher net worth individuals.
Adrian, thank you very much.
Thank you.
Next, Rathbone's Ed Smith talks with Emma about what the budget means for the UK economy.
Hi, Ed.
Hello, Emma.
So, of course, like any Chancellor, Philip Hammond yesterday tried to deliver a positive message about the UK, saying that he was going to build a Britain fit for the future. But hidden in a lot of his positive rhetoric was the fact that the economic outlook for the UK has been significantly downgraded.
For sure, and downgraded to really quite a large extent. This is the first time since the Office for Budgetary Responsibility started doing the forecasts that growth is expected to be below 2% in every single one of the 5 years forecast. It's expected to average just 1.4% over the 5 years, and that puts UK growth right at the bottom end of the spectrum when we look at expected growth across advanced economies.
I suppose this is a very simple question and there may not be a very simple answer, but why the downgrade? Why does the outlook for the UK economy now look worse than it did a year ago?
It's largely to do with the outlook for productivity. So, like pretty much any forecaster, the OBR over the last 7 years has forecast productivity to return to around about the 2% trend sort of 3 years out. But UK productivity and productivity globally, actually, the UK is not unique in this. Productivity has disappointed time after time, quarter after quarter. And in fact, actually this year, productivity growth in the UK is likely to be negative, which is a really dire outcome for an advanced economy, which relies on productivity to really grow because demographics aren't with us and we've got plenty of debt.
So a downgrade in economic outlook, a downgrade in productivity. There was some, I suppose, good news in the fact that Philip Hammond expects our debt to GDP to peak before waning next year, peak at 90%. Now, that doesn't sound like too much to boast about, 90% debt to GDP, but it is lower than some of our peers, although it is higher than the European recommendations for debt to GDP, isn't it?
Yeah, I mean, 90% would still place us probably second or third, would probably give us the second or third lowest debt to GDP ratio in the G7 economies. The US, over the forecast period, will probably get up to between 120 to 130% of GDP. Japan, obviously, in the 200s almost now. So I think it's really not something to boast about because the Conservative government or the coalition government originally thought debt was going to peak some years ago, in the middle of this decade. And they've consistently missed those targets. And I think and the main reason why they've consistently missed those targets is because of growth. And of course, the downgrades today are compounding that.
This seems like a very gloomy chat. We've talked about negative productivity growth, negative economic growth, or at least, downgraded economic growth. And now we're hearing that actually the debt forecast may not even be true either. Is there anything to be cheery about?
Well, I think what's important to take away is that it's low growth, not recession. We're talking in very gloomy terms, and often when we're talking gloomy terms, we're predicting a recession, which usually means a bear market for investors. We're not saying that. The good news is that a lot of the gloomy expectations are already baked into things like the sterling exchange rates. We think the actual exchange rate is as cheap relative to the economic fundamentals that drive exchange rates over the long term as we've ever seen over the last 35 years. So a lot of this gloomy picture is baked in. We're not facing a big sort of cliff edge in some domestic investments. In the budget, there were some positive things, but they were all relatively small. So it's great that we're seeing an increase in the tax credit for research and development. That's really important to attract business investment, particularly in the Brexit environment, because we know that a lot of business investment is intended to be allocated towards R&D over the next few years.
Ed, thank you very much.
Thank you.
Will interest rate rises impact income stocks? Next up is James Harries, manager of the Trojan Global Income Fund, who shares how the bank policy will impact income opportunities.
Hello, James.
Hello.
So this fund has been running for a year, but you have been running funds of this nature since 2005.
Yep.
The environment that we're in now is becoming one where there are interest rate rises. We've had one in the UK last week, and we're indeed expecting one from the Fed in December. Interest rate rises, because they've been so rare, have meant that people have looked to equities, to funds of this nature for income. Does this mean that when interest rates rise, global income stocks will not do as well?
Well, possibly, if you did think that interest rates were going to rise a lot. Now, my contention is I'm not sure they will. Now, you might say I would say that, wouldn't I, because I'm an income investor. But we genuinely believe that the backdrop remains one where inflation is remarkably quiescent. I mean, the reality is we've had 9 years or whatever it is of incredibly aggressive policy, and inflation remains incredibly subdued. CPI, for instance, ex-shelter in the States, is hovering around 1% and falling. Elsewhere in the world, inflation remains very low. And that's pretty remarkable to me. And the markets actually have a similar view. You would have noticed that the yield curve in the States particularly has been flattening. That's an environment where potentially the bond market's saying that longer-term inflation expectations are falling rather than rising. So although I accept that there have been 1 or 2 rate rises, and after all, they would love to put rates up because they've got to have something to cut in the next downturn, I'm just not so sure that they're going to go up nearly as much as people think, and therefore I'm afraid I reject the premise of your question.
And a lot of your fund is invested in US equities. The follow-up question would be, are you worried about that sort of allocation? But it sounds to me like you're not, because the things that have been propping up US equities, this supportive central bank policy, you don't think is going to change anytime soon? Well,
actually, I do think it's going to change. They do seem to be reaching a point where they think they are capable of being able to row back some of the aggressive policies put in place. Where I differ perhaps from the received wisdom or potentially the consensus is, I think that quantitative easing has raised up the price of assets and has led to, therefore, greater confidence, greater consumption, greater activity than otherwise would have been the case. If, therefore, you reduce QE and potentially then risk assets were to do less well, then it wouldn't be at all surprising to me if the bond market were to strengthen, if rates were actually to fall in the absence of QE. And therefore, policy being less aggressive and continuing to invest in the manner which we do, notably in the US, I think is entirely consistent. I think the last point to make on that is, although the US market in aggregate is relatively expensive, at least relative to some other equity markets, we think this cycle is likely to end with a strong US dollar. Either because of the relative vibrancy of the US economy, or because of interest rate differentials, or because there's a problem. And for whatever reason, if that's the case, then you want to make sure that you've got a full allocation to that currency in the latter part of this cycle.
And of course, you are an income investor, but valuation must be important because you're not going to buy income at any price. Are you finding at this particular juncture, with markets having done so well, that it's harder to find those opportunities, or actually do you find in a market as diverse as that actually you're still seeing options?
Well, it is undoubtedly harder to find value than it was, there's no doubt. It's no secret that markets are at a pretty elevated level in terms of valuation. Of course, that tells us very little about what markets are likely to do in the short term, but it gives us quite a robust framework with regard to what expected returns are likely to be from here, and they're likely to be pretty low. We do continue to find companies that we're excited by and that we can invest in. In aggregate, we are generating a free cash flow yield of just over 5% in the portfolio, which we'd expect to grow at some 5% in the future. So if you're starting at 5%, you're growing at 5%, and you add a bit of inflation, then you could expect a return in the future that's adequate. I wouldn't want to promise it, and it won't be every year, and it's not guaranteed. But we think there are reasonable expectations even from here.
And looking at the portfolio, finally, it is majority in developed markets at the moment, but I know as a global income investor in the past you have allocated as much as 20%, even more than that, to emerging markets. Do you foresee a time that you will do the same again in the near future?
Well, maybe not to quite the same degree, but it's undoubtedly the case that the opportunity is going to present itself at some point in emerging markets. Now, my belief is this cycle has all been about reach for yield, ironically enough, as an income investor. In my view, the most egregious reach for yield there's been is in emerging market debt markets. Now, I suspect, therefore, at some point we're going to have quite a interesting credit cycle in emerging markets, focused on emerging market debt areas. If that's the case, if you've got a problem in emerging market debt markets, you're likely to have a problem in emerging market currency and equity markets. And I think then you will get a great opportunity, because if you're able to buy fantastic companies by then cheap currencies with all the structural favourable attractions of emerging markets, of young populations and functioning banking systems and low levels of debt and all those things that we know about on the far side of a credit cycle, then that will be a terrific opportunity, and that's something we'd hope to exploit in time.
James, thank you very much.
Thanks very much.
Many multi-asset fund managers are holding more cash than usual at the moment, but should individual investors do the same? Emma speaks with Dan Kemp, Chief Investment Officer for Morningstar Investment Management, about the role of cash in your investment portfolio.
Hi, Dan.
Hello, Emma.
So we're here today to talk about cash, because it seems that many multi-asset managers are holding more cash than usual, and indeed in Morningstar Investment Management's own portfolios you are holding more cash than usual. Why is that?
That's absolutely right, and I think that reflects the opportunity set. Like other multi-asset managers, we're not constrained to some sort of benchmark. We're looking for opportunities to invest people's capital to deliver a return that's better than the risk they're taking. And at the moment, with prices so elevated, there are very few opportunities that we see where that's the case. And so in that situation, it's good to have some cash to keep your powder dry and look for better opportunities. Now, remember, in the past, it's been the case where you could have held equities, or when they look unattractive, bonds have looked attractive. So you could operate a sort of seesaw effect. That's not really the case at the moment, and that's why we're holding a bit more cash.
And what is the role of cash in a portfolio? Is it just simply that you are ready to go when those opportunities arise?
Well, that's certainly one of the reasons for holding cash, this idea of keeping your powder dry. But we have to remember that although cash is quite a safe investment in the short term, it's very, very dangerous in the long term. So at the moment, as we all know, despite the interest rate rise, we still have very low interest rates that are far below inflation. And so if you were just to hold cash in let's say a current account, then over the next 20 years, you would probably lose out about 60% of the gain versus inflation. So that's a huge loss. It's very, very dangerous over the long term. And so people shouldn't be complacent about holding it. But it's a great way of holding your money. Once you've used all the opportunities that you see that are available, then to hold back and wait for new opportunities to appear.
Now, we all know that interest rates are incredibly low, despite the recent bump, and inflation is looking higher than it has been in recent history. So why are we still so attached to cash?
Well, the old adage, cash is king, really reflects our behavioural biases. There's two particular biases, I think, that are at play. The first is loss aversion, that we hate losing money much more than we enjoy making it. And, of course, with cash, unless your bank goes bust, and fortunately that's not an issue for most people, then that will protect your money. And we value that protection probably more than we should. And then secondly, there's present bias, or temporal myopia, that we tend to focus on the short term rather than the long term. And so we'd much rather, as humans, surety in the short term than the possibility of much more gain in the long term. And that's a bias that we need to overcome. As investors, we constantly need to be thinking about the long term rather than just the short term. And arguably, if you're someone that's going to suffer from these biases, or you've struggled to control these biases, it might be better just to invest and forget about it for 20 years. We know most people can't do that, and most people can't stomach that sort of volatility. So cash has a role, but focus on the long term and remember that we have these biases that lead us in the wrong directions.
Dan, thank you very much.
Will the gold price hit $1,800 again? Old Mutual's Ned Naylor Leyland says UK investors in the gold price have seen returns inflated by currency, but there is more profit to come.
Hi, Ned.
Good morning, Emma.
So the first question is, why is the gold price not higher, considering the significant political turmoil we've faced over the last year?
Well, my first answer to that would be to point out to you that gold in sterling is actually doing very well, particularly after what happened with Brexit a year ago. Obviously, sterling weakened, and so the sterling gold price, in fact, is near its all-time highs. Investors always look at gold in dollars, but unless they're actually situated in the US, that's probably not the right thing to do. So gold is doing okay, but it is also important to say that gold doesn't move based on geopolitics. So you might think a bomb would go off and gold would go up, but actually gold moves on the basis of real interest rates or real yields. So that's the relationship between inflation and interest rates. If you're losing money holding cash, gold will go up. Or if you think you're gaining purchasing power holding cash, gold will go down. And that's really what moves the price.
And so then interest rate rises, as we saw in the UK last week, and as we're expecting to see in the US in December, that sort of thing should have an effect on the gold price.
It absolutely will always have an effect on the gold price, but it's, again, always about the relationship. So if we think inflation is going faster than expected, and we think interest rates are going slower than expected, then gold will absolutely go up, and vice versa. So it's the relationship between both those things. That's what drives gold up and drives gold down. But I do think gold should be in all portfolios anyway, because it has a very obvious decorrelating effect on portfolios, which is something people are looking for.
And looking at US dollar terms, although we are situated in London, the gold price is around 1,200 and something. It was 1,800 and something in 2011, 12, 13. Can you, as an investor, expect to see those kind of prices again?
Well, in my view, undoubtedly yes, and even more so with silver. In fact, if you look at gold and silver on an inflation-adjusted basis over a very long time frame, you're going to find there's nothing else you can buy which is trading at a fraction of where they were 30, 40 years ago on an inflation-adjusted basis. Really, these are absolutely counter-cyclical hedge assets. Now, you may not have needed to own them for 40 or 50 years, but I'll tell you that cyclically, this is a moment where you do need portfolio insurance, and so you're just getting it at a much cheaper price than you might otherwise have had 3 or 4 years ago.
And of course, there are several ways to invest in gold. One is to invest in the commodity itself. Another one is to invest in the equities that are exposed to that. Where do you see, as a fund manager, the opportunities in gold and silver at the moment?
Yeah, so you want to buy the gold and silver mining equities if momentum is moving towards the metals. So if money's coming in, they're going to provide a geared effect. So a fund like the one that I manage will deliver you somewhere in the order of a 2 to 4 times the underlying gold price effect. What that means, in my view, is you can hold a smaller allocation at portfolio level and deliver a much more meaningful outcome. Whereas if you hold physical alone, really you're probably going to end up needing quite a large allocation to deliver the sort of attribution characteristics that you're really looking for. So I think the opportunity is in the mining stocks, although we have around 20% of our portfolio in physical as well. So it's a combination of the two things.
Ned, thank you very much.
Not at all, my pleasure.
Looking for income stocks? Ex-Newton fund manager James Harries has been picking global stocks for income for more than a decade. He shares with us 3 companies from his new Trojan portfolio.
Hello, James.
Hello.
So what's the first stock you'd like to highlight today?
First stock we'd like to highlight today, even though we're very long-term investors, we think is looking pretty attractive, is Novartis. It's, I'm sure you know, a Swiss but global pharmaceutical company. It has 3 branches to the business, basically. It's got a branded pharmaceutical business, a generic pharmaceutical business, and a quite fast-growing eye care franchise. And we think for all those reasons that this is a business where the long-term prospects are good, the returns on capital are pretty exciting, where there's been quite a lot of restructuring and focusing in on spending money more wisely within this quite large and disparate business, and yet is offering a dividend yield of about 3.7% in Swiss francs and trading at slightly north of a 6% free cash flow yield. So I think all of that together makes for a pretty compelling opportunity today.
And what's the second stock today?
The second one I highlight is a little bit different, is Vonovia. It's a German residential property company. They own something like 330 units in Germany. I mean, there's several points to this investment case. The first is it's genuinely inexpensive. It's pretty remarkable, actually, that the portfolio within Vonovia is trading at a discount to replacement cost. Sitting here in London, that sounds remarkable that you're able to buy property at a discount to replacement cost, but you are. They're also upgrading the asset base, which means that the NAV is gently increasing over time. And because of their scale, they're able to do this very attractive economics. So overall, you've got a pretty interesting asset, which is yielding about 3.7%. But there's also a macro element to the story, because, of course, Germany, being within the European Union, has effectively zero interest rates. Now, if there were to be a problem in the future, such that the euro were to break up, and it's certainly not something I'm predicting, but if there were, then you effectively hold a Deutschmark asset, which is incredibly inexpensive, and therefore I suspect would do well in that scenario. If the euro doesn't break up, then it's likely that Germany is going to continue to have the wrong interest rate, essentially. And therefore, you could argue you should discount the value of this property at a far lower discount rate than the market is currently doing, and therefore it looks, again, incredibly good value. So there's lots of reasons why we think this is an interesting, inexpensive asset in a world where they're quite difficult things to find today.
You mentioned the macro element. Germany has not been doing too well on a GDP level, despite it being seen as the sort of Euro powerhouse. It's actually been sort of flirting with recession. How linked is the residential property market to the economic health of Germany? Well,
obviously it is linked at the margin, but I would say on a longer term view, the shorter term cyclical concerns relating to the German economy are not particularly concerning. I would say a more important fundamental driver is both positive immigration, both into the country and within the country. There's quite a lot of immigration, notably amongst the younger population, into cities at the moment in Germany. And that's providing an underpinning, if you like, to property values, which I think should be relatively sustainable, even in the context of relatively sluggish economic performance.
And what about the third and final pick?
The final pick is good old Domino's Pizza. We really like this business. It's a very obviously simple and predictable business. It's a very large part of the UK, particularly, but also elsewhere, pizza delivery business. They've been very proactive in terms of their offering with regards to technology, the Domino's Pizza app. There's been two things that have recently, at least, knocked the valuation down to a more attractive level. The first is some level of competition from Just Eat or similar sorts of apps. Now, we think they're more about other forms of takeaway, such as Indian and Chinese, which tends to be far more fragmented and don't have such a good technology offering. And therefore, we think Domino's can hold its own in that context. And secondly, also, there'd be concerns relating to the UK consumer and how there is somewhat of a cyclical downturn, or potentially a cyclical downturn, related or unrelated to Brexit. All of those reasons meant that we were able to buy it relatively inexpensively with an attractive dividend yield, which is growing through time. Now, it's already done rather well, I'm afraid, so it's less good value than it was, but we still think that we're given an opportunity to invest at a cyclical low in what we think is a really attractive long-term franchise.
James, thank you very much.
Thanks very much.
Still hungry for more income stock picks? You're in luck. Up next, we have Adrian Gosden, manager of the GAM UK Equity Income Fund, with 3 dividend stock picks from his new portfolio.
Hi, Adrian.
Good morning.
So what's the first stock you'd like to highlight today?
I'd like to highlight a stock that appears in our top 10 holdings in the GAM UK Income Fund, and that is Land Securities. Land Securities is a £7 billion market cap UK-listed company, and it deals in commercial property, big retail and big offices. It trades at about just over 30% discount to its stated assets, so no one really values them as the value appears to me. They give a dividend yield of over 4%, which is attractive relative to the market. And the good news is their loan to value is only 20% of the value of the properties. That's extremely low across history. Now, as I look at that, it clearly has some concerns about maybe the UK's role, particularly London, in Europe going forward. And the shares have been very poor since the Brexit vote. But if you look in the bond market, they've just issued a bond in September of this year, a 40-year bond to 2057, on a coupon of 2.7, and it trades at a premium. So the bond market's looking at the same set of assets, same buildings, and saying, we like it. The equity market is looking at the same set of assets and going, we need a 30% discount and I need a 4% dividend yield. So to me, there is value there. What will be the outcome of the Brexit negotiations? I have no idea. But at a 30% discount starting point, it's in my top 10.
And what about your second stock pick?
The second stock I'm going to pick is probably in the mid-cap area, sort of 600 million, is Halfords. Halfords is a UK retailer, and it sells us bikes, car parts and tents, if you tend to go to those festivals. just had results, and they showed a 1.4% growth in their like-for-like sales in their stores. So not really dynamic, but it is growth. It's not going backwards, and 95% of the people who do buy online is click and collect. They actually go to the store to get it. So they do have that contact point with customers that I really like in my retailers. The shares are trading on a PE multiple of 10, and the dividend yield is 6%, and it is growing. There's a new CEO to join in January, and I'm really excited that this is just a share that is UK, retail, but that's reflected in the share price.
And how much do you have to consider whether what's reflected in the share price is correctly reflected, and how much do you think there is growth opportunity there? Because I suppose there is an argument with inflation running higher than wage inflation that actually if I'm being squeezed as a household, I might not buy a bike.
No, absolutely. And that's the important point, that they keep their prices competitive. But I think you are going to see some wage inflation going forwards. Not immediately, but it is starting to come through. I notice in a lot of the companies I analyse, those that have been on minimum wage are clearly seeing that increase. But elsewhere in the group, I think we've been in this brutal period where there's been no wage increases. They're starting to occur. So that backdrop, I think, gets better. But your point's absolutely right. Your sales offering has to be dynamic. It has to be the right price. And you've got to be there for the customer going forward in terms of servicing it.
And what about the third and final pick?
The third and final, I think I'll go much smaller, maybe down to Wincanton, which is a UK distribution company. Again, we've recently heard from them. You'll notice a feature in things. I like to have recently heard from someone because it's a very uncertain world out there. Again, a price earnings multiple of 9, not very well regarded by the market, and rightly so. This is a cyclical business. They win contracts, they lose contracts, pricing changes. They are doing a great job at moving food and things like furniture around the UK. So again, maybe a UK-focused company, but one that is winning contracts. The recent one it just won was from IKEA. That's a good contract to win. So I like to see businesses making progress. If people don't like them because of the geography they're in, that's fine too. But you've got to hear from the management, let them articulate their strategy and see if it's in the price.
Adrian, thank you very much.
You're welcome.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.